Money market funds, an overview of their functionality, advantages, and disadvantages. What is a money market fund? A money market fund represents a type of mutual fund that primarily allocates its investments into highly liquid, short-term financial instruments. These instruments encompass cash, cash-equivalent securities, and short-maturity, high credit-rated debt securities like U.S. Treasuries. The fundamental purpose of money market funds is to provide investors with substantial liquidity and minimal risk exposure. They are also referred to as money market mutual funds. Despite their similar names, it's important to distinguish between a money market fund and a money market account, MMA. A money market fund is an investment vehicle sponsored by an investment fund company, devoid of any principal guarantee. Conversely, a money market account is a form of interest-bearing savings account offered by financial institutions. Money market accounts are insured by the Federal Deposit Insurance Corporation, FDIC, and typically come with limited transaction privileges. Key points to remember. Money market funds are a category of mutual funds that primarily invest in short-term debt instruments, cash, and cash equivalents. While not as secure as holding cash directly, money market funds are still regarded as a highly low-risk investment option. These funds typically generate income, either taxable or tax-free, depending on their portfolio composition, but they offer minimal capital appreciation. Money market funds are best utilized as a temporary parking spot for funds before making other investments or planned expenditures. They are not suitable for long-term investment strategies. How money market funds operate. Money market funds function much like a standard mutual fund. They issue redeemable shares or units to investors and are obliged to adhere to regulatory guidelines, such as those established by the U.S. Securities and Exchange Commission. These funds may invest in various types of debt-based financial instruments, including bankers' acceptances, BA, short-term debt secured by a commercial bank, certificates of deposit, CDs, savings certificates with brief maturity periods issued by banks, commercial paper, unsecured, short-term corporate debt, repurchase agreements, repo, short-term government securities, U.S. Treasuries, short-term government debt securities. The returns generated from these instruments are linked to prevailing market interest rates, meaning that the overall returns from money market funds are also influenced by interest rate movements. Varieties of money market funds. Money market funds come in various categories distinguished by the nature of their invested assets, maturity periods, and other characteristics. Prime money fund. A prime money fund allocates its investments to floating rate debt and commercial paper issued by entities other than the U.S. Treasury. This includes corporations, U.S. government agencies, and government-sponsored enterprises, GSAs. Government money fund. Government money funds direct a minimum of 99.5% of their total assets into cash, government securities, and fully collateralized repurchase agreements backed by cash or government securities. Treasury fund. Treasury funds focus on investing in conventional U.S. Treasury-issued debt instruments, such as Treasury bills, Treasury bonds, and Treasury notes. Tax-exempt money fund. Tax-exempt money funds offer earnings that are exempt from U.S. federal income tax. Depending on their investment portfolio, these funds may also provide exemptions from state income taxes. Municipal bonds and other debt securities predominantly make up this category of money market funds. It's worth noting that some money market funds are designed to cater to institutional investors and require a substantial minimum investment, often around $1 million. In contrast, other money market funds are tailored for retail investors and feature lower minimum investment thresholds, making them accessible to individuals. Regulation of money market funds. In the United States, the oversight of money market funds falls within the jurisdiction of the SEC. This regulatory authority establishes essential guidelines governing the characteristics, maturity periods, and permissible investments within a money market fund. According to these provisions, a money market fund primarily allocates its investments to top-rated debt instruments with maturity periods not exceeding 13 months. The fund's portfolio must maintain a weighted average maturity, WAM, of 60 days or less. This WAM criterion ensures that the average maturity duration of all the invested instruments relative to their weights in the fund's portfolio remains below 60 days. This maturity limitation serves the purpose of guaranteeing that only highly liquid instruments are eligible for investment, safeguarding investors from being tied to lengthy maturity assets that could impede liquidity. Furthermore, a money market fund is restricted from investing more than 5% of its assets in any single issuer to mitigate issuer-specific risk. Nevertheless, government-issued securities and repurchase agreements are exceptions to this regulation. Pros and cons of money market funds. Money market funds face competition from comparable investment alternatives, including bank money market accounts, ultra-short bond funds, and enhanced cash funds. These alternatives often have more diverse investment portfolios and target higher returns. The central purpose of a money market fund is to offer investors a secure avenue for placing their funds in safe, highly liquid, debt-based assets with relatively small initial investments. Within the category of mutual fund-like investments, money market funds are known for their low-risk, low-return characteristics. Many investors opt to temporarily park substantial sums of money in these funds. However, money market funds are not suited for long-term investment objectives, such as retirement planning, as they offer limited opportunities for capital appreciation. Money market funds hold appeal for investors due to their fee structure, which typically includes no loads, meaning no entry or exit charges. Additionally, some funds provide investors with tax advantages by investing in municipal securities that offer federal tax-exempt status and occasionally state-level tax benefits as well. Advantages: exceptionally low risk, outstanding liquidity, enhanced returns compared to bank accounts. Disadvantages: lack of FDIC insurance protection, limited potential for capital growth, vulnerability to shifts in interest rates and monetary policy. It's crucial to remember that money market funds do not benefit from FDIC federal deposit insurance coverage, unlike money market deposit accounts, online savings accounts, and certificates of deposit, which are safeguarded by this form of insurance. These funds, like other investment securities, are subject to regulation under the Investment Company Act of 1940. For active investors who possess the time and expertise to search for the most favorable short-term debt instruments, offering attractive interest rates at their desired risk levels, a DIY approach to investing in various available instruments may be preferable. Conversely, investors who are less experienced may opt for the money market fund route, entrusting the task of money management to the fund operators. Typically, fund shareholders maintain the flexibility to withdraw their funds whenever necessary, although there may be restrictions on the frequency of withdrawals within specific timeframes. So if you enjoyed this video or found it helpful, please consider giving it a thumbs up, leaving a comment down below to share your thoughts, and hitting that subscribe button to stay updated with our latest content. Your support means the world to us. See you.